If I didn't ask you these questions, as you'll see in here, there's a myriad of programs that are available, but without knowing what your goals are, it's worthless. Welcome.
Welcome. So we'll keep it casual. We're just going to go through just a quick little packet and then open it up for Q&A at the end if you guys have any questions. So my name's Corey Houston. This is Andrea Dolan. We're with Future Home Loans.
Hello.
And go ahead. We'll kick it
All
off.
right. So we will get started. So we are part of Future Home Loans. It is a veteran-owned mortgage company. So Corey and I have worked together for a really long time. Prior to being where I am now, I worked in banks throughout most of my career. And what is really cool to me is that you get to do stuff like this, which when you're working in banks and you've got all this other compliance and red tape, and you can't just get together and like talk about stuff and who's doing what and whose product is going well, what are your rates, what are my rates. So there's a lot that are happening right now in the environment, in our world. You guys hear about rates? 1,000,000%, right? We're getting, all of a sudden my email has just been like lighting up the last couple of days, like, is it time to refinance? Is it time to refinance? Is it time to refinance? So we're all starting to get those questions, and Corey will talk a little bit about the market and some of the things that we're seeing as far as housing inventory and stuff like this. But we pride ourselves on customer first. We're really big about 5-star Google reviews. That's really, the biggest piece of, again, who we are. We actually pay our processing or operations team based on how well we perform from a customer standpoint. So that's really important to us. But really kind of a little bit more of who we are. If you look at the second page, I did not page number these, but if you are not familiar with the difference between being a mortgage broker versus being more on the retail side or in the banking side, we just have a little bit more flexibility with who we can go to from an investor or a lender standpoint. So that's super important when we look at things like loans for investors themselves. There are things that we're able to do in our world that I could have never done back in the day working in a bank. If anything was outside that kind of cookie cutter lifestyle, you couldn't do it. If anything required really a conversation with an underwriter to say, well, let's talk through why. Here's the mitigating factor. This is why this makes sense. You didn't even have an opportunity to do that. Where in today's world, we can pick up the phone, we can have a conversation, we can explain the background, we can send letters of explanation. We can really make sense for why this makes sense to do for someone. So it just gives us a lot of opportunity that we just didn't used to have in the past. We are available 24/7, which is the other really cool thing. Corey loves a weekend phone call or a late night phone call, as I'm sure you guys do as well. When the phone rings, you answer it, right? You just answer it.
I'm trying to get that through his head. Somebody else is backing me up.
It is so true, though. I find that the spouse is probably the one who complains more than anything else, or the kids. The kids, I think, also will complain about it. But it's our, an open sign outside of your business. You have to show people that you're around and you're available all the time. Otherwise, we don't have that full brick and mortar all the time to have that open sign. That's what we do. We answer the phone when somebody calls. And what you find very quickly is, as much as you think your client base is loyal to you or other people are loyal to you, you will find when they're in a place of panic and it's a Saturday and they're house hunting and they're looking, they will talk to whoever answers the phone. It sucks, but it's the reality of what we do. It's the worst. It's the absolute worst. So with that being said, we make ourselves available as much as we possibly can. We have access to in-house marketing and things as well. So like, let's say you had an open house this weekend and you needed an open house flyer. We can support you at the open house. We could do a flyer for you. We can even have like ideas of what programs are available and rates are available. So we can do all that. So you have access to all those types of things. Corey has a staff of people that work with him, for him, everyone to look at it. If he gets really complicated tax returns, he can send it over to a group of us. We're gonna look through it for him so that way he can do more of this kind of stuff, spend time with you guys, build relationships, more so than worrying about the numbers, the dotting the I's and crossing of the T's. So I mentioned already that we're veteran owned. We offer a lot of different types of programs. So when you think about an investor loan, and Corey's going to go into these, what are the types of programs that you think of, or what, I should say more importantly, what are limitations that you think would exist for somebody who's starting to get into buying an investment portfolio?
Usually it's, for me, it's a DSCR, the credit score. And I'm learning now as you do the renovation, you buy to cash out, that you think you're doing okay, but then you kind of already bought at the, so you say you buy a house for $200K, it's worth $350.
Yep.
But then you did a renovation, now you're at like say $275. Like, okay, I can, but you can't, if you're trying to keep it rental, there's not much room to cash out, because if you depend on your credit score, you could be 75%, whatever the value of the house. I'm like, man, credit score is so important to get better rates for investors, and you still can do it, you just got to be better, really start at the deal and get in a better entry level. So that's what I'm learning.
Sure. I mean, a lot of that comes with the scope of the work for the project itself, right, as well. So when you're on the renovation side of things, you really want to consider what you're trying to do up front and hoping that there's enough equity on the back end, like you're saying, to make it make sense.
Yeah, and that DSCR program, so we'll talk about that in here, but that's one of those types of products that's specific to that investor world. It allows you to do something that your typical kind of mortgage, like if I talked about to my parents and I said, what's a mortgage? They'd be like, oh, it's a 30-year fixed product. It, fits in a box, and that's all that they would even think exists. And now there's so much out there. And when you look at somebody who's interested in starting to become an investor, really it's, what are you wanting to do with these properties? Are you wanting to get cash flow from them? Is it something that you're going to hold on to and you're going to rent it out? Or is it something that you're looking to renovate, fix and flip? Are you looking to just get the appreciation out of that property and it's a short-term gig and that's really what you're interested in? But a lot of this, and really any of our roles, is just the questions, those funnel questions. You ask a bunch of things to try to figure out what is really the interest of what someone's looking for. And then it's our job to be like forensic scientists and help figure out, okay, here are the products that are available based on all the information that you gave me.
Correct.
But if I didn't ask you these questions, as you'll see in here, there's a myriad of programs that are available, but without knowing what your goals are, it's worthless, right? So I've talked enough about who we are as a company. The biggest thing, again, is we're local, we're here. Corey, you just told me, how long have you lived in Clay County?
Almost 30 years, so just a couple.
Just a couple.
But
it is the new 20.
that's right.
I totally
That's
agree.
right.
This age is a number, girl.
But yet I've moved away twice and I've come back every
this
time.
side town.
So
Yep.
here we are. But moving forward, with all that being said, just a kind of a quick market update, and we'll get some feedback here. But you'll see some graphs in front of you, and what we're looking at is initially on the housing inventory. So I talk about this weekly at a meeting that we have on the networking side of things, but inventory is up, right? Homes are sitting a little bit longer. It's about a 20% average from last year as far as where we're at right now, something that Katie and I have discussed several times. Your second graph here is in regard to price reductions, and it's not necessarily our market right here in Northeast Florida. This is more of a implication of a nationwide example. And what we saw was there was some high evaluation at the end of last year, and then there was a fairly decent drop at the beginning of this year, but it was starting to recover. So that gap is slightly more accurate than it was in the beginning of the year from a valuation perspective at the end of last year. The one good thing is, if you see the last graph, the data for purchase applications in my world, as far as the mortgages are considered, they're up from last year. And so what that is supposed to read to us is that more people are entering the market, buyers are getting off the fence, those avid renters are deciding to say, hey, it's time to actually purchase a home. Or, in the same token of our meeting here today, investors are saying, now it's time to get back in, or get that first investment property, or start building that portfolio again that maybe they offloaded a few years back. So, positive direction here as far as applications are considered.
Yes, right? That's a good thing.
where I was going to move to next is some of the things that we've talked about previously, which are some different loan options to consider. So you have your typical just conventional loan. Most people would call a conventional loan your typical, normal, most known type of loan program, right? Outside of an investment, does anybody know what the minimum required down payment for a conventional loan would be typically?
20%.
What would you say? 20%? So that would all be correct in terms of an investment. But if it's a primary residence,
Three.
it could be as low as 3. And the majority of the time it's 5 if you want to take advantage of better case pricing. But that's just something to consider, right? So in the investment world, yes, a lot of times you'll hear the 20% down, but there are times, depending on the lender, that they'll take 15%. Or if you go to the 25%, you can get better rate and better pricing. Ideally, it's a matter of what is your plan with that property? How long are you going to hold? Is that going to become a rental property, or is that going to become something that you hold in the short term to take advantage of a market that's going to come back around, right? So just a little bit of a tidbit there. Portfolio loans. Does anybody know what a portfolio loan means? Go ahead.
Is basically where the person, the broker that you're writing with, will write it out their own warehouse lines, their own money and funds. So they
Right.
have a little more leeway and flexibility to make a discretionary decision
Right.
on how they want to underwrite that.
Perfect. Couldn't have said it better. So going back to a conventional loan, you have two main investors, and you hear them all the time. They're in the news. It's Fannie Mae and Freddie Mac, right? They're the investors. They're the ones that have the money. They're backing that loan. So if Future Home Loans is the lender, it's not our money that's coming to the table. It's the money from that investor that's coming to the table to back that loan program. To your point, if it's a portfolio loan, that means that I have a very deep pocket and I'm backing the loan myself, right? So there's higher risk on a lender standpoint. On that standpoint, really see that standpoint on standpoint. That's really good. But it's a way to take advantage of a loan program for somebody that might not qualify under your traditional guidelines. Okay. All right. So hot topic for tonight, the DSCR loan. So it is a minimum requirement for a 20% down payment. That is very typical across the board. Again, if you're able to do the 25%, there are some pricing advantages in doing so. Ideally, one of the most important features about this loan is it's a non-income qualifying loan, meaning that you don't have to qualify via your personal tax returns or your business tax returns, or if you're a W-2 employee. It goes outside of the box to where it's more focused on a market rental and a ratio that's applied to what the actual payment is. So we'll go a little bit more into that here soon. Bank statement loans are something that are coming around and definitely are becoming more popular. So a bank statement loan simply is a lender will look at either a 24 months worth of bank statements, business bank statements, or 12 months, and they'll take an average of depositories during that time to create an average monthly income that will then be used for a qualifying purpose of getting that loan. So again, it's a way of when you're not necessarily disclosing everything to Uncle Sam, and there's still an opportunity to create an income scenario that you could qualify to purchase either a primary residence, a second home, or an investment property. Hard money was mentioned before, hard money private lending. We do have a partner that we would even consider what they call a 30% down, no DTI, no income loan. So it's a option to doing a hard money loan, because a lot of times with hard money loan you have higher interest rates. I mean, sometimes we talked about it earlier, 12 to 13% could be a typical rate for a hard money lender. And then there's also time constraints that private money or hard money lenders will do as well, where you might have 90 days in order to make a move on something, or some even have like per diem. So interest is accruing daily, and every day you're holding on to that property, or you're waiting on that electrician to change out that panel so you can get it on the market. It takes another week. That's another week of interest that you
I
might
took
be
yours.
subject to. So
Two.
call the
Greedy.
Ryder Electric. No bull, just quality work, right, Matt? So those are things to consider. Fix and flip loans is just like it sounds, right? I mean, you see it all over the news. This is something that Katie and Chris are well invested in. They can probably talk about it a lot more than I can because they've had the experience. But there's opportunities there when you're looking to rehab a property, to renovate a property, and then look to make an income on the back end by marketing that property and selling at
Very
an option.
HGTV.
So, yeah, that's right. That's right. Right. Everybody can do it, right? I mean,
Oh, yeah.
yeah.
DIY.
Everybody can do it. Yeah, if Tara can, and all them can do it, why not? And then commercial loans. So commercial loans is typically something that is 5 units or more. That's what's considered a commercial loan. I mean, if it's 1 to 4 units, they consider it a personal residential. But commercial loans could be a 5+ unit. It could be a space that we're sitting in here currently. There's definitely some opportunities there, but that's where you get into cap rates and some different things on an income standpoint.
Do you guys do bridge loans?
So yes, we have versions of what we call a bridge loan, right? So a bridge loan is something where there's interim financing on what you're looking to purchase, and you're still needing to take equity out of something that you're looking to sell, right? That's kind of my definition of it. But I'll stop saying but we have different programs out there. There's a buy before you sell program. So buy before you sell is an example of that bridge loan opportunity. There is also a company out there called Knock that myself and some different colleagues have worked with recently, where they will take the equity position of your current property, and credit is a big part of that. But they will take that equity position, they will derive a number that they will express as what they're willing to give in that loan, and then typically it's a 6-month payback. So they'll give you up to 6 months to sell your property and pay that loan back. There is a clause, a due on sell clause at that 6-month period that loan is due. So that's the risk. But if you work with the right realtor and the home's priced right and staged right and all those things, there shouldn't be any issue in taking advantage of that program.
Now, does that pop up? I don't know about. Does that pop up getting credit score? So they're trying to buy another house. Like, how does that factor into if they're trying to use that to buy another house? Like your DTI for that temporary 6 months, like.
So what's cool about it is if there's a bridge loan in place, it's almost looked as secured funds. So we have lenders that will take the current mortgage payment out of the DTI equation. So that's
in fact, no, you're going to sell the house. So it's
correct. So they're banking. It's a contractual agreement that they're saying that home is going to be sold within that 6-month period. What also is a feature of that bridge loan is whatever amount that you're approved for, they will take 6 months of mortgage payments, of your current mortgage payments, out of that amount and take it from that deduction. So you're getting basically preloaded 6 months of mortgage payments. So the current lender for the remainder of that financing or that delta or that gap is going to know that. So they're going to see the funds in that account. They're going to be able to source it, and therefore that's why they can take it out of your DTI. So it's a pretty cool little feature.
Yeah, that is.
There is a cost to do a bridge loan financing most of the time. It's not, just a free of charge type of option. Most of the time, there is around a 2% cost of the total loan amount, plus closing costs. So closing costs will generally run around $2,000, maybe a little bit less, in addition to the 2% fee of the loan amount.
Now, what I'm seeing with these loans, maybe you can help me out, is like I see people who bought like 2 or 3 years ago, and they're either they can't make the payment or they're stuck, and they like what do you suggest for those kind of people who are in these loans and they can't refi, they don't have, because there's no equity, and D.R. Horton's still building new houses down the street, and they're just like stuck with their mortgage. Like how do we help people out in this?
That's a good point. Katie and I just had that discussion today.
I just talked to one of those, and I'm like, well, no,
It's yes, but he's in that position to where there are new construction in the areas. So when you're looking at home value, something that was appraised at $400,000 last year, at the end of last year, which we talked about on a price reduction standpoint for this year, Katie said maybe might be worth $360 now. on a good day,
good
right? The issue with that is it was an unfortunate situation. It's a divorce situation, but they have a first mortgage, but they also had to get a second. They had to get a home equity line in order to pay the interest of the party that left the property. So now they have a combined balance that is much higher than it was initially, and they also have a valuation of a property that was $40,000 less than it was at the end of last year. Unfortunately, to his case, there was an assumptive process that he was trying to take advantage of with his current lender that didn't go through, and here he is 9 months later trying to do something. In that case, it's what is called a cash out refinance, because there's two loans, you're trying to bring them together in order to take advantage of a new loan. And in that scenario, we can technically go up to 90% loan to value, but even then, you take a huge pricing hit anytime you go over 80%.
Yeah.
So when you have somebody that might have taken advantage of a rate that is in the 2s or the 3s in response to buying a property 5 years ago, is now going to be subject to a 7% rate or even higher in this case if he goes to 90%. And now, does it make financial sense to do that? Probably not. So what we look at that point is, if there's a hardship in place and it's a true hardship, that's where they get with their current servicer and they say, we're in a hardship. Are there modification opportunities? So a loan modification is completely different from a refinance. If a refinance doesn't fall within the guidelines of being able to be done, then that's where they're basically, going in and pledging the hardship to their servicer that says, is there some type of relief that we can take advantage of? And that relief might be a payment reduction, that might be a principal reduction where they take a certain amount and they throw it on the back end as repayable in the event that they ever sell the property. But ideally what they're looking at is, can we keep this homeowner in this property for X amount of time, or in the event that none of these options, whether it's a refinance or a modification or the case may be, are available, then unfortunately it's a sell and bail type of deal.
There's really no hope for some people at some point.
Yeah, there's a lot of speculation in the market right now that in response to the whole pandemic there was a lot of people that took advantage of adjustable rate mortgages. And so they're saying, if adjustable rate mortgages are now going to be coming due starting this year and into the next few years, what are the current terms and what does that adjustment look like? Mm-hmm. Right? Because they could have initially locked in 2.5%, and we're in a different market now, and depending on the caps associated with their mortgage, that 2.5% could easily jump to 5.5%, 6.5%. Mm-hmm. And now that mortgage payment could go up anywhere from $300 a month to, double that, depending on their loan amount. So it's putting people in a position to where, is it still affordable, or now is it not affordable, and what do we do now? So there's a lot of discussion around that. But hopefully, with all the experts that are, in the market right now and trying to forecast what our future looks like with the economy, and paying attention to the 10-year treasury and paying attention to the bond market and mortgage-backed security market, what is to come, and hopefully it's a more favorable response where we stay in this declination environment of rates to where we normalize maybe somewhere in the 5s, hopefully, because if you look at the last 10 years, let alone the last 40, there's people that would arguably say that we're in a normal environment now when it comes to an interest rate. But with all the pandemic responses and things that have happened in the short term in the last 5 to 10, there's a lot of focus on those rates when we should be focused in looking forward of what's to come. Mm-hmm. So, any questions on that?
I'm not, no, but I was just on your DSCR loan, do y'all do condos for that program?
There are lenders that allow condos for that program. Mm-hmm. Yep. Just like any other condo, it's all about the condo project. It's all about condo documentation as far as what is the investor concentration, do they have the budget, or is the reserves. So they will still do like a typical condo questionnaire to make sure it's a qualifying type of project that is meeting the risk side of it, but there are some opportunities there.
The only thing that I'll add too is that when you look at that conventional, that more cookie cutter kind of scenario, if you live in one of the units and rent out another one, that's still classified as a primary home, not an investment property. So that's kind of like a little loophole if someone's starting to get started, they're going to live in one, rent out the other 2 units or whatever it is that they have set up.
Because I just had this scenario come up where I just got a property but has 3 individual houses on one lot. So that doesn't count, right?
That does not count, right? No, this
So I'm
is
kind of screwed if I try to, like, I can live in one, but I can't make the whole property. How would that work?
now are they each? It's one piece of land with
One piece of land
three
with 3 small houses.
three individual units. Yeah, no, those.
They all have to be attached, right? To account for what you're saying.
So I'll probably take that as a takeaway.
Yeah, I'm
because
trying.
there's some gray area there. Typically speaking, ideally, it's what you would think of. It's your Riverside home. It's the 4 units, and if you occupy one of the units, you can technically finance it as a primary residence, which you would also avoid a 20% down position. You could do a minimum of 5, which is a huge advantage for somebody that really wants to take advantage of a primary residence, but that has tenants that they can use towards an investment side of things. So that's one thing too. And then also on that note, on a qualifying aspect for debt to income, they can use that rental income in there with current lease agreements to try to offset some of the expense. So that's another cool option.
But yeah, the 3 individual.
Depending on the size or the structure, sometimes it can be classified as an accessory unit. So you can have a larger main with maybe 3 small accessory units depending on whatever program
Correct.
he's looking at.
Yeah. I actually just did that on a bank statement. Classic example. It was a main home with a manufactured home in the back of the property, and we classified it as an ADU. We classified it as an accessory dwelling unit, and we were able to continue with that approach.
Have you seen more of those in Clay County area? Because I looked at one that was Clay County, kind of like that.
Sure.
Not that long ago.
Yes, they're definitely more common in the Clay County area than, let's say, St. John's or Duval, because we have multi-generational families that are starting to occupy a single parcel, and then when they move on or decide to go a different route, and that property comes available, then it's, what type of financing options are available for that
Now,
property.
could they count that back, mobile home, as a rental, and then?
Yes, they can. Yeah.
But you don't get value, right? Like if
if it's
appraiser is
in-
coming out, they'll only evaluate the main property.
It depends on the positioning of the. So if it's a non-occupied property, a lot of times they'll take it as an ADU. But if it's an occupied property with a lease agreement, then it's more of a typical 2 unit, and they will use the rental in that property to offset some of the debt to income.
Not say just on, so would it have to, like, say I'm gonna do a conventional, or say I'm gonna do a VA loan, would that mobile home have to pass the VA appraiser as well? So like, it's 1980s mobile homes now, and if it doesn't, you like, okay, disregard it, just count the main homes. How would that kind of look at?
So, in terms of a VA is an all-encompassing look of the property itself. They're going to look at, if it's just a single-family home with a shed in the back, the shed could be looked at technically, yes. And in that scenario, what a VA appraiser or even FHA, what they're looking at typically on an appraisal standpoint, just so we're clear, is it's something that would be deemed quote-unquote hazardous to the property, right? A lot of people think that, if there's some peeling paint or you need some, what I would call quote-unquote refreshment or lipstick to the property, that's not really what they're looking at. They're looking for things, if it's got a decking on the back, is there loose deck boards? Are there holes in the floor? Are there safety measures, right? Is there noticeable water intrusion, right? Things of that nature. If there's
destroying organisms.
correct. If there's a shed in the back and there's broken windows and there's missing, a hole in a metal roof, and it is something that can come up on a VA appraisal, possibly. It does become appraiser dependent as far as if they're going to call it out or not. There are some appraisers that would just say, it's dilapidated, it's non-existent. They'll look past it. But that is the roll of the dice is just depending on who goes out there and takes a look.
I'm just looking at if you're a vet and you're trying to like maximize your VA and,
Sure.
and get a multifamily unit.
Sure.
Then.
Yeah, it's happened, but it is very much property specific.
Well, what's also interesting about that conversation is like if you look at the Airbnb, VRBO market, there's actually a lot of people creating these shed-like, they're actually nice livable spaces.
Like tiny homes, right?
Yeah,
Yeah.
or something variation of that. I mean, I've literally seen sheds, and I mean, it'd be like you're staying at the Hyatt or something, and they're making money Airbnb-wise off of it. So it wouldn't be surprising to see. It's amazing if you look at what's going on there with the actual structure of the property. So it wouldn't
Right.
be surprising to come across that scenario
Sure.
in today's market.
I just want to do that just so if I buy a home, I can maximize and not have to do like the 10 punches down because
Right.
I need more cash out to refi go next property.
Correct.
We
So
only know what you tell us. We only know what you tell us.
that's right.
So true. So true. I can't hear you. I can't hear
What we
you.
see on paper, there's some things I don't want to hear.
Right.
I want to hear that
Right.
you're giving your grandma back those gift funds next week.
Right, exactly. Don't tell me.
That's right.
Don't
A
tell
gift's
me.
a gift, correct?
Or what the payment plan is for the gift. No, I don't want to hear about
That's
it.
Hear that.
Yeah. It's so true.
Going back to the property types, we've gotten to it, like to your point, there's a lot of unique property types that are coming around. Whether it's, we're here in Clay County, there's barndominiums getting built, right? Or there's,
yeah, that's really
there's
popular.
tiny homes getting built. Yeah, typically speaking, it's all in an appraiser standpoint or in a financing standpoint, it's all about comps, right? So is it something that is comparable to the area, and can an appraiser go out there and find 3 comps, right? If they can't, then we're probably going to be in some type of creative financing situation. That's really what it comes down to.
It's amazing what's specific to the area too. We had come last week and there was a class for title that Landmark Title did, and they were talking about mineral rights. And I'm like, that's mineral rights? What is that? Like, I hadn't heard much about it before, but it's really big out in this area based on just old rules and old family structures and how they have to set it up. But everywhere you go has their own little set of stuff that is specific to just that area, those little niches.
I had a loan probably 6 months ago with a realtor partner of mine that we were probably 3/4 of the way through the process, and that came up in title. And it was on a deed that was originally written in 1950 something, and we had to go back on property records, and it was a clause regarding just one tract of this parcel that was designated towards mineral rights. And ideally, of course, we just wanted to bypass it so we could close the loan for the buyer and call it a day. But it's something that came up, and we had to go through the measures of, okay, are these mineral rights, have they been transferred along, or was there a quitclaim deed at some point that got rid of these rights? Are the rights actually on the parcel itself? Are they part of an easement for the road and the parcel next to it? So there's a lot of different things that can come around. I was shocked. I'm like, if we dig 3 feet in our yard, I don't see any minerals. I just
Right, I
see
ain't got no
water
minerals.
and soil and mud.
Right.
So to have mineral rights in Northeast Florida was just
Right.
kind of mind blowing to me. But I was
Right.
like, man, maybe there's some stuff in Callahan to go check out.
Right,
Buy
right.
some property in Callahan and
Right.
hit gold. Who knows? But
Who knows?
crabs and frogs.
yeah.
And I'm like, I'm serious. In my garage, I get all these little crabs, and I'm like,
Like, where's that coming from?
over near Moccasin Slope Park.
Okay.
Yeah, and this little subject, and it's like, God, where are these crabs
Yeah.
That's
coming
it.
from?
That's it.
Driveway's covered in them.
That's funny. Yeah, like different areas, right?
So I think what's bank statement, is that what you're on?
Yep.
Bank statement and 1099. I mean, I talked about it. These are alternative document loans. This is something that's outside the norm. Bank statements, I touched on it. 24 months, 12 months. Take your average. 1099 is somebody that is that self-employed contractor that works for a company, but it gets paid like somebody that is self-employed, right? And so we can actually do as low as a 1-year 1099 if there's history of employment in that same industry, or get creative on that side of it as well. So To move right along on
When I
that,
first started in this industry, which was in 1999, by the way, I was obviously a lot younger. And we were in a call center, and it was a self-employed guy, and I asked him for his tax return. So he comes back and he's like, do you want my tax returns that I give to a mortgage company or the one that I give to the government? And I was like, and I literally had no idea. I put him on hold. I went to my manager and I was like, which ones? He's like, oh dear, hang up the phone.
Yeah.
But the bank statement loan the government does allow you to write off certain things when you're self-employed. So it does give you an opportunity to be able to say, hey, listen, I do have all this money. I just take allowances to write off what I can, and that's what I'm allowed to do to be able to pay less taxes. So it does give that allowance. But yes, no, we want the government tax returns, not the ones that they use for the mortgage company.
we don't necessarily want that crafty CPA involved either.
Pre-subprime,
Oh.
that might have been
Yeah,
okay.
just write it on a napkin. Anyone have a napkin? You're good.
Back then.
Right.
Not so much anymore, though.
You're absolutely right. You're absolutely right. That would have been like, yeah.
I have a
2
friend of
sets
mine that
books.
works in the Central Florida market, and there's just a different clientele down there. And almost every single time when they have initial conversation, they say, "Oh, don't worry, we'll be back. We're amending our tax returns." So that's always a real special discussion for him.
Special discussion.
That's right.
Right. Right.
We're doing an amendment to our tax returns. So,
Right.
a little bit of a red flag there. But,
A little bit.
all right, DSCR, hot topic again. So debt service coverage ratio loan. All right, so to kind of go through this real quick, it is an investment property cash flow loan, meaning that you can do a purchase, rate term, or cash out refinance of a residential investment property. Okay, so it is residential only. The borrower will qualify on a real analysis to determine the property cash flow. So what that means is when the appraiser goes out there and they do the income approach on the appraisal, they will do the market value rent for that property. That market value rent is then compared to what the proposed mortgage payment for principal, interest, taxes, and insurance will be. And as long as that's over a certain ratio, every lender's different, but it could be most of the time 1, 1.1, 1.2. But ideally what they're looking at is there enough rent there on the market that it will cover the mortgage payment plus some, right? And ideally, that's what they're looking at on a qualification, because they're not using your personal income. They're not using your tax returns to qualify. They're using what the market is supporting in that live time space in order to cover that loan. Does that make sense? All right.
You did this really weird hand raise. I'm a little nervous for your question.
So, did I assume from this last bullet point that other loans aren't able to be closed in an LLC?
So what's cool about that is not till recent, at least in my experience, when you did a personal loan for a residential property, they took the business side of it out. It was under your personal tax ID, your social, your everything. So when I go run your credit report 6 months later and you still own that property, that mortgage is showing up under your name, right? There was a lot of people in the past that would say, okay, no big deal. They would close the loan in their personal tax ID and their social and everything else. And then they would get with a fancy attorney and they would put it into their LLC post-closing. The problem with that is there's something called a due on sell clause. And if a lender ever sniffed that out or somebody ever called it out, that mortgage, that loan note can become due in full right then and there. So that's the risk, and it's very high risk. Now, was there a lot of people that probably got away with it? Yes. There's a lot of people that probably got away with it. But now this is a legit way of saying, okay, I have something I want to do, and I want to put this in Corey Houston LLC. So when I go to qualify for, Katie Sweet Denali that she's got sitting outside, I don't have to take this mortgage as part of my debt to income on my personal income. Does that make sense?
Perfect sense.
Cool.
Corey, are you guys doing a lot of these loans, DSCR? Because I'm finding it really hard to find properties for buy and holds to make it make sense based off of the price I'm getting it for and the interest rates that I would get.
I would say if I was talking to my colleagues, for somebody that never did a DSCR loan before, has probably been 15 to 20% of their business this year.
And every fix and flip we have, I ultimately want to buy and hold it.
Mm-hmm.
But when I look at what I would finance it for, and interest rate, like if I'll barely break even on rent on a good day, so I keep coming across that problem. I guess I would have to put a lot more down for it to make sense.
Right. So I mean, it's definitely property specific because it's a 20% down position, but it's also, you know, it could be 20% down, but then you're having to throw X amount more into that property to get it to where it's a marketable enough property to
rent,
getting you
yeah.
that high rent, right?
Right.
And so I think that's the balance. What's cool about the program though is you can be a first-time investor or you can be that avid investor. And there's no limitation as there was on a conventional loan route that says you can have a maximum number of investment properties. That's the
Yeah.
idea.
Again, I've researched a couple of ideas that have again, there's a credit score come into effect, because then I've seen where like I may qualify like if you got like a high 600, low 700, you might get, okay, I can only do 80%. But if you're like at 800 or 750, you might be able to get a 90%, value of that property.
So on
With a better rate versus 11 versus 9% or something.
Sure. I mean, typically speaking, on the DSCR, you're going to be held at that 80% loan to value, right? But when you're looking at a rate sheet, if I'm the 600 or the 660 and you're the 800, I could very much be at 8.5% while you're sitting at 7.5.
So that makes it.
And that's a huge difference.
Our payment would be better off if you look
Right.
at it that way versus not
'Cause
just
that-
like on the 75, 80, but like what your rate is. 'Cause
Right.
Okay, now the rents make sense.
Because that's,
Very
to Katie's point, yes, I mean, that could be the difference. That, $400 difference in payment can make or break it, right? Bring them. Come on.
They're saying in 2025, 1 out of every 5 home purchase is an investment.
I know, isn't
Which is
it
crazy.
Everything that's hitting the market right now are all fixer-uppers.
Yeah,
behind it.
right. And like the inventory being higher, it's staying on the market longer, and it's just like breeding ground for it.
You gotta stay close to this guy because, he's about to pick up a whole portfolio before you know it, right? All right, so renovation loans. In full disclosure, this is not something that I have focused a lot on, only because there's a lot that goes into a renovation loan for it to make sense, right? It doesn't make sense to the buyer that says, what can I actually get this property for? How much do I think I need to put in this property? And then lastly, to your point, am I gonna hold it? Am I gonna sell it? What's my time frame, right? On a lender side of it, the risk is more associated not only with the value of the property, but who is doing the work, when's the work going to be done, and what does that future market value look like, right? And so the reason why we brought this slide into picture is I wanted to point out that there's more than one renovation program. So, and I would say not too long ago, probably 5-10 years ago, the biggest marketed program was that FHA 203K program. It was like, that was the renovation loan, right? And so there's other loans out there. As you can see on the conventional side, you have Fannie Mae Home Style, you have the Freddie Mac Choice Renovation Loan, and then there is a VA renovation loan. A lot of people don't know that. So that does exist. So what that does is it combines the VA mortgage with funds that are going to be needed for the repairs, right? And then they base it off of a future valuation, future market value. Just with any of these programs, especially with the FHA and the VA, there are specific people that they will allow to do the work. And if they're not on the list, then they have to qualify to get on the list. And that's a lot of times where, again, this program gets sticky because, Chris, you might come to me and say, hey, let's do a VA renovation loan, but I have my people. I have my electrician, I have my roofer, I have my trades guy, I have my plumber. If they're not on the list, they need to qualify to get on the list. And there's ways of doing that. There's forms that lenders have them fill out with all their credentials and show their budget and their own capital positions and things like that. So there's hoops that they have to jump through in order to qualify. So
How do you have to stay in these homes for a certain time period before you can't just like fix it up with VA and I just had to move. I just
So, in short, no. However, VA specifically, they would like you to be in the home for at least 12 months. Anytime you're doing a VA loan, whether it's a regular VA loan or a VA renovation loan, ideally they're thinking you're staying, right? This is going to be your place for at least 12 months. Now, could you get orders if you're active and go somewhere? Sure. Could there be a tragic event, like a death or something like that, that goes beyond that scope? Sure. But by nature, they just want you to be there to live as your primary residence, to stay as the primary residence for at least a 12-month period.
And if I move, say you got the VA or FHA, if I move after a year, do I have to change the loan to a DSCR loan, or can I stay a VA loan or FHA loan as a rental because I moved?
No, it can actually. So if let's just say it's VA, let's stay on the VA topic for a minute. If it's a VA loan and you have to move within a 12-month period, you got to take off, go out of state, or whatever the case would be. You can convert that to an investment property. The one kicker for that, though, is in terms of your eligibility, it stays as part of your eligibility. So it doesn't come off. So you're going to need to qualify for the next purchase that says, can I still do 100% financing? Or do I not have enough eligibility left to says, if I hold this property and purchase another one, will there be a minimum required down payment? So there's something called an entitlement calculator with the VA that we can calculate that for them, but that's the kicker for that. So you can hold, you can convert to an investment, you can technically have 2 VA loans at one time, but you just got to qualify accordingly, right?
Would the FHA be like a 3.5% down and the VA be 0 down, or?
So if there's enough entitlement, you can still do a 100% financing 0 down VA loan. FHA does not allow you to have 2 FHA loans. So if you have an FHA loan currently on your primary and you take off and you want to convert that into investment property, cool. But the FHA will not allow you to go get another 3.5% down FHA loan. They won't do it. I've tried.
3.5% down is the primary residence. Anyway,
Right.
So we're trying to
Right.
go get that on an
I mean, if I'm
FHA.
telling you it's going to be my next one.
Yeah.
Well, I can tell you personal experience. I've had an FHA loan since 2005 with my primary residence. I moved to the island for 5.5 years. I reported I was non-occupying. There's nothing we did. Then I came back. There's no
police,
enforcement piece
right.
to it, but obviously you don't want to get into the red areas of not disclosing, but like whatever you disclose is what's disclosed.
Right.
Yeah.
Right.
There used to be some gray area that said, okay, if there's a job transfer, if the property is at least 100 miles away from the existing property, if there's an improvement to the property that you're going into a larger home, things like that. There used to be some parameters around that, but I've never personally been able to get another FHA loan approved.
And
But
you
there's
have
an
to
existing.
have PMI off in 5 years too. So.
Right. Right.
Right. Which
Right.
now it's life of the loan, right? And so that's another kicker with FHA.
So now the PMI is for the life of the loan?
That's correct.
Not after like 80% or whatever?
No. So conventional has a built-in feature that says, actually, when you hit a 78% loan to value off the original market appraisal value, that PMI will drop off automatically. It also has a feature that says when you think that you might be at that 80% mark, that you can make a servicing request to the current servicer that says, will you remove my PMI? And sometimes that lender, that servicer might say, yeah, we got you, because they have an automatic valuation and they think the equity position is there. Or if you press it enough, they say, all right, if you're willing to pay for an appraisal and the valuation is there, then we'll remove the PMI. So those are options.
The FHA loan, isn't there a clause though, if you put, I know you only have to put a 3.5, but if you put 20% down, I thought there was a way that at the 5-year mark you could get the PMI off.
I don't think so.
It used to be, that's the thing.
Because I bought mine in 21, and that's how mine is.
Is it?
That's what I'm saying. And the only reason why I know is I missed it by 1% of my down payment. And
Now, I would say that when you put 10% down, there is a reduced MI factor. But
That
for
did
that,
used to be
I
the
would-
case, though.
I would
can't
have to.
remember
I
if
would have
it's
to take that one away. as
Yeah.
well.
Is it your primary residence? Is your primary?
You can have
But
it.
anymore, if you're holding for that long, most of the time there's going to be a. So, in general, most of the time there's a 5 to 7 year period that a homeowner does something with their property, right? So within that 5 to 7 years, they sell the property and move on. They convert it to an investment property. They take advantage of a refinance because there's better terms. They take advantage of a refinance because now they have equity in the property and they want to do something, right? So to hold for 20 to get to that point would probably be far-fetched, but I'd have to take that away.
That's the first I heard.
Yeah,
Since
and
they've
just how rare it is that somebody would put that much money down on an FHA loan today with where pricing and stuff is. But it definitely used to be the case. But same thing, I don't remember if it changed. You could ask the help desk if you want.
Yeah, we have a help desk that we can ask.
We do have a
I
help
just
desk.
wondered if it was still like that.
Yeah, I could take that away. Actually, you want to write that down. FHA.
I'm going to go with a 90% chance that it's the same.
Yeah.
But I'm not a betting girl, so we'll see. But I feel like that did not change. Not
Just so we can open up to
Thinking about
Q&A and keep everybody's time in the forefront here. So just a quick overview of the mortgage experience. So it all starts with the conversation, right? So whether I'm starting the conversation with somebody, but most of the time it's you guys that are starting the conversation, whether it's the realtor, or maybe you're at the home changing some wiring, or you're sitting at the desk with a new client and something comes up, right? Something is coming up in that conversation to where I'm usually the second call, right? I'm not usually the first when it comes to what we want to do in purchasing a home. So it starts with the conversation, and then if we're looking into options, that's where the application comes into play. If we find the property, we go into contract. The next big step is the appraisal, because that's what it's going to say, is this an allowable loan? Is the lender going to back the loan? All those things. Underwriting is your intern process before you actually get to the closing day, right? So in a nutshell, that's your mortgage experience. And then lastly, I could probably harp on this slide as much as I talk the whole time. What not to do before loan closing. Right. So, I'll just go through them real quick. Open new lines of credit, make any large purchases, quit your job, move money around, have your credit pulled. I have stories. Yeah. In my 13 years of being in mortgage, I can tell you that I have stories for every one of these bullet points, and some are just shake your head, it is what it is, and some are just super sad, honestly. I have been at a closing table and had a older couple that were of retirement age and had the perfect home picked out. I mean, it was close to family, their grandkids, in the area they wanted, all the above. And the gentleman that had been at his job for 30 years mentions at the closing table, I just can't get enough of today. I just retired last week, and here we are, right? The closing attorney literally said, we're done here, right? And I'm the lender at the table. And I have to sit here and say, okay, because we just did because they do a verification of employment typically within 10 calendar days of a closing date. This guy retired 5 days prior to closing. No idea, nothing, right? Now, in his saving grace, I was able to get retirement income because he had been there was a pension, and so I had to go back and get from his employer his pension income of what that may be and when that was going to hit, and it was going to hit within a 90-day period, and it was just enough to get him qualified again. And so we had to postpone closing by like a week, and his story saved. But I also have been in situations where any of these topics here were just straight deal killers. And it's unfortunate, but I mean, I can't harp on it enough. When I take an application and I have those conversations, and I'm just, whether it's a first-time home buyer or the person that's purchasing their 5th home, I'm constantly going around this because it is a process, it is a loan, and whether it's a car loan or a mortgage or, you know, a life insurance policy, and you don't make your first payment, there's risk to it all. So
I would actually I would add apply or open. Don't even, I have my clients don't even apply.
correct.
See it on the report.
And just a quick note to realtors, or just in general, so this is classic as well. To your point, you just brought this up. I can't tell you how many times that we have been cleared to close early, which we're good at. We're good at that. And they get so excited to where they go to rooms to go.
Start buying the furniture.
And they open up that credit line, and they put that sofa on there and that kitchen table, or you know, they go to Home Depot, right, and they open up that business credit card, and they put all kinds of they pre-pay for the flooring that they're going to put in, and all that. And there have been cases where we've had to dig into that because there was a credit inquiry. Now the lender wants to know about it. Does it exist? It does exist. And then that projected payment has thrown us over the edge. And then now we got to find another option, if there even is one, in order to get that thing to the closing table. So super important. I mean, I tell everybody eat ramen noodles the last week until they go to the closing table.
Right?
Also add, do not schedule or go on vacation.
That's it.
Right?
That's it. Like, what do you mean I can't close in Mexico?
If you're married.
Right. Yeah, and don't forget that.
Yeah.
But you know what's, you need the other person here. But you know what's so crazy is when we talk about the whole, like, back to when you're in like a bank kind of setup where there's so much compliance and listening to phone calls, you couldn't give credit advice at all. And even something, but even something as simple as do not open up any new credit cards, or do not do this, which is not, I mean, it's not like you're doing anything wrong, but because that's classified as credit advice, you couldn't even say like that kind of thing. So the amount of times that we had clients that would do something last minute because they didn't know, no one told them, and we weren't allowed to. So the fact that we have like the ability, oh my gosh.
To be able to have that conversation and educate. And I just tell them, listen, this is what it is. I'm here to educate you and share this with you. You make your decision, but I want you to know.
Right.
And I tell them, you do any one of those things, I cannot save your file.
Right.
That's it.
They are well versed in this.
Right.
It's funny. I just had a conversation with one of your employees, Odie, on your property management side.
Yeah, that's a whole separate company.
From Crossview, though, different company.
Realty, that's the
whole nother side,
yeah,
right?
that's two different companies.
But he had a similar situation where he had a family member, and it was exactly like that.
The rules. He
Right.
broke the rules.
So,
I try to have the conversation.
yeah.
Thank you so much.
I think the only one that's really got me before on deals is when the spouses don't communicate, or they don't like tell they know the truth. And I've had a deal where I guess I don't know how you guys do the process now, but this is like a couple of years ago where the wife didn't talk about her student loans at all to the lender, and the loan was under the husband's name. And we get closer and closer to closing, then whatever the mortgage report that finally pulls the student loans, like, well, hold on 1 second, well, there's like $75K in student loans.
Oh yeah.
And like, oh, that, but she's not on the mortgage or whatever.
I've been in a situation where the wife racked up $75,000 in revolving credit cards.
Oopsie. Twice.
Twice. You know the story, and the husband didn't know about it.
Oh,
I mean, the ex-husband did.
the exit, right?
Yeah.
Not a partnership at all.
Yeah, that's
No.
shady.
Fixed it the first time and was like, do not ever do that again. And she did it again. They came back to him again to buy another property, and she had done it again. And he's like, I don't even want to have this call right now. Like, I don't even want to
Yeah.
talk to this guy
Yeah.
because he's about to flip his lid.
Yeah. And student loans is a hot topic because they're all coming due again.
Yes.
And so people have been in deferment for, I know people that have been in deferment for 10 years. And now their student loans are becoming due. And better yet, because they've been in deferment for so long, they come due for whatever reason. They don't know that they're due, or they just pretend that they're not due.
Right.
And then they go into default. And somebody that's had an 800 credit score their entire life now is like 620 in 30, 45 days worth of time. And this has become a real issue here recently where there are ways to fix it. There are some remedies, but the reality is it is a hot topic.
So you want to see the answer for FHA? It's 10. It's actually, it did change. It's not 20% now. It's if you put down more than 10%, it remains for 11 years, then it
Okay.
comes off.
All right.
So it's not for the life of the loan. Anything else is for the life of the loan.
And that changed as of this year.
That changed,
Okay.
yeah. So
There you go.
we all knew it changed. We just didn't know how it changed. And I was
There you go.
saying it didn't change
Where's
at
our
all.
FHA
so-
person? She's got to know that. She's got
Yes. Oh, yeah. Oh, of course. Getting her pizza when I'm in the middle of answering her question.
What other, right? What
I think one thing that we've faced, and I think she's got one now coming up, is like we get other lenders that are not as good as you guys, and they'll say like, "Oh, we can fix this person's credit score like 5. They might have a 520," and we tell them like, "Well, we'll have to talk to someone. Oh no, you can't get a house now. No, this other lender down the shack said, yes, I can buy a house."
Sure.
And
Well, isn't that what happened in 2008 then?
but I mean, it's happening now still, but then you're having to feel like a bad guy saying I can't help you, and they'll go out, of course, they'll go out to another realtor and say, no, they're going to help me buy a house and go through the whole thing.
Yep.
And then, so how do you deal with those people? Like,
So we can't control what other people set as expectations, right? And I can't. What I tell people when we have, well, that's not what I heard, or that's not what that other lender said, right? I can say that, well, I'm going to give you what's in front of us, right? And so in my world, even though there are some gray area, there's a lot of black and white, and the black and white is the guidelines, right? What I also say is, I kind of lean on my experience. So I've been doing this for 13 years, right? And I would say that the reason why I'm sitting at Future Home Loans and I'm not sitting at the big bank is for one of our main pillars, which is the client experience. What I also have one of my lines, and I'm sure Andrea's heard me say it more than once, and I know you have, is I'll give you a quicker no than I will a yes. And what I mean by that is I don't want to set false expectations and not be able to follow through, right? And so in your point of credit repair, yes, we have options for that. Is it an overnight fix? No, it's not. A lot of times it's going to take a little time, and we'll go through the motions and we'll talk about it and we'll set the expectation and we'll monitor it and we follow through, which is the important part. But when I say I'll give you a quicker no than a yes, I'm not saying no, have a nice day. I'm saying not right now. Like, we will create a plan. We will figure this out. We'll get there eventually. And yes, credit repair is one of those things. I mean, and it depends honestly how much repair is needed, right? If you look at a car, if it's a small bumper ding, okay, we can, maybe it's as simple as paying down some revolving debt, and then focusing on maybe a collection item or two that are there. And once we're able to do that and provide ample documentation that I can then go to the bureaus with, shoot, that might be a 14-day process. That could be a 30-day process, right? But if it's, you have just a pocket full of judgments, you got, a repossession, you have just some really big items on that report, that could take months, that could take a couple of years, depending on, how bad it is. So we're definitely in the position of setting expectations, being a realist in what we're looking at, and then also that third component, which is the most important, is that follow through.
Yeah. With that being said, knowing that you guys know how to do it right, and a broker looks at all the options and they're like, these people specifically, it's in the low 500s. They have late payments all the way back for the past 4 years, and it's just not doable. How can another lender go in right behind you and say, oh yeah, here's a soft pre-approval.
Right.
They get under contract, and you're like, after butt cheeks clench the
Right.
whole contract. you're
Right.
Like, when's this gonna
Right.
fall out?
Right.
What's the likelihood of that happening?
And that's the other thing. I mean, that going back to our different types of loans. Unless it's a portfolio loan where I can back it myself, I can't speak on that. I can't say this is 100% going through guaranteed. Even with what we call A-paper loans, even when it's good credit and the debt to income and all the boxes are checked, like I can't sit there and say I guarantee this thing's going to the closing table because that's the process. That's where we go through the motions. And we could have everything perfect to the very end, and they lose their job 5 days to before closing. Lender does a verification of employment. They're no longer employed. We don't have a loan, right? I had a contract travel nurse, right? Been doing it, was a nurse for 20 years, been doing the contract travel nurse thing for the last 5. Was in between contracts, and when they went to do the verbal verification of employment, the company that she worked for said that she was unemployed because she wasn't currently in a contract.
Oh
You want to talk about somebody good at jumping through hoops and getting some stuff pushed through though? He's like, nah, I'm not accepting that.
That's the swagger.
So
That's the swagger.
So what we ended up having to do is, I pushed all the things, right? So, look at the credit, look at the low risk when it comes to the debt to income for this, scenario. Look at the money in the bank. Look at all these what we call quote unquote compensating factors. But the end all be all, as I'm fighting with the HR to her company, as I'm being an advocate for her, as I could tell you the whole backstory, but I'll just tell you this: she was a Colorado resident, moving to Florida, widowed recently, young kids, just trying to come here to be close to family. That was her story. Talk about some emotions involved, right? And what we were finally able to do is get her a contract that was going to be future dated with a future start date, but that we actually got terms from that hospital of what that contract and that employment and that income would look like, and that was our saving grace. That's what we ended up using.
Just to also add to what she was asking, there are lenders that'll say, oh, we can do we have programs at 550 or 540 credit score, but what my experience has found that if everything else is pristine and your credit score is a 540, you may get it through, or they're going to have you just jump through hoops where you're, talking about clenching the whole time.
Everything else is a shit show.
So Corey could probably back this up, like I'm just now meeting him tonight. But whatever programs that he's strong on, he's good at, and he knows they're solid. Like for me, I want to take my client in from a position of strength. So if you're, 10 points short on the credit and you could do this and just get it up, let's do the homework, get it up, and then go to the lender with your file.
Right.
So if you have a great relationship, you have a good broker and loan officer, get him to evaluate, get the game plan. He's going to be honest with you because he doesn't waste his time and the client's time about what it's really going to take to get it to the table.
Right.
So I don't, when they call me and say, oh yeah, well I saw someone who has the 550 or 560, I'm like, well, if you want to spin your tail on that, enjoy, but this is what I'm telling you, we'll make it happen.
Sure.
So let's execute A, B, and C plan, and we'll get you there. That's just my approach to the whole thing.
If I'm not comfortable with the initial upfront approval of a loan, I'm going to express that, right? Because your time is valuable, my time is valuable, the client's time is valuable, right?
And the realtor, they're involved.
Right, and there's a lot of different hands in what I call hands in the honey pot, right? We have a term called shakies in the loan world, right? Where if it's loan and it's got hair on it and it's just not something that I'm comfortable with, it's a shaky environment, right? It's the foundation is not there, right? Shaking. I mean, those. Think about it, right?
Yeah.
But it's all about that expectation setting, you know. And a lot of times, the lenders that will do those type of loans is not something that we necessarily have we haven't pushed a lot of loans through them, so we don't have a whole bunch of pull on the back end, right? And so we're going to set that, hey, we'll throw it in there, and I'll set expectations up front, but it's not necessarily that it's going to come out on the back end. The other side of that too is I've seen it both ways. I've thrown that loan in there, and everything went just fine, and we went to the closing table. So I can't say that I haven't thrown the Hail Mary and it hasn't been grabbed on the back end, because I've had those miracles. But it's all about communication. It's all about expectation setting, and that's the one thing that we try to deliver.
My last question is, as a self-employed person, when is the best time for us, like as with this 2025 gets to an end and 2026 starts, when can I use my 2024 taxes to last minute and not have to do 2025 taxes? Is it like January or February? Like when is the lender going to be like, hey, we're in 2026 February, I need your 2025 taxes?
So every lender's a little different, but I would say usually it's around that May cutoff, right?
Yep.
At May 15th.
April, May-ish.
April 30th, May 15th. Somewhere around that, what's tax day is April 30th. So somewhere in that April, May is usually where they're starting to say, okay, if it's not done yet, then I need an extension, right? So they want proof of extension, typically number one. And then depending on how long it keeps going, they might want like a current profit and loss for the current year, just to show that there's some type of sustainable income that was shown from 24 in previous years. One cool thing too on that note, just as a little bit of a tidbit, is Freddie Mac on a conventional loan, if you've been self-employed for over 5 years and it's documented, a lot of times they'll use your most recent tax year only, and they don't necessarily have to show the 2-year average.
Yeah, which that was a pretty cool
So
update.
if you get creative, then sometimes that's a benefit.
I learned from the VA, I had a great year like 3 years ago, and your 2024 you lost a little bit of income.
Right.
So now if you do 2025 and you didn't make and you lost more income, then we're gonna maybe not do the loan at the value we want or whatever. Because now we see you're steadily
Correct.
going down.
So that is factual. If you made $100,000 in 24, or 23, and then you made $80,000 in 24, they're not going to average them. They're going to use the 80 grand. They're going to use the declining income. So then if you keep declining, they're going to use less and less and less, right? But if you go the other direction, it's increasing income, it's a positive effect, they'll average it out typically. The other thing too, on a tax return basis, which I think you asked me about not too long ago, is are there things that can be added back in for qualifying income? The answer to that in short is yes. So if you're looking at a Schedule C and it's just your general business income, your sole prop, or you're an LLC, and Schedule C is what you generally have, you don't have a separate business return. If you have depreciation or depletion, those are things that can be added back into the bottom line. So sometimes that's a difference of a qualification to affording a little bit more than others. If there's a Schedule E, if you're going to the investor side of it, if you have rental properties and you have losses on Schedule E, they can negatively affect your income, just as an FYI.
Also, the one-time purchases, like if you had one time where you had to get a fridge or appliances, they can sometimes.
Or it's not going to repeat.
It's a one-time.
Yeah, as long as it can be explained and understood and approved by the lender side of it, yes. Yeah. Because you have sometimes where there's a big loss that's shown on a corporate tax return, where you can say, oh, that was a one-time expenditure because depending on maybe it's a manufacturing company, and it was one expensive piece of equipment that was going to keep the operations going, and it can be explained, it can be shown, it can be a lot of times it can be thrown out of the equation on a quote-unquote loss side of things. What else?
Good questions.
When you're a hard money lender, What's your average rate range typically?
I would say that most of the time I've seen anywhere from 10 to 15%. And it's going to be very specific on what it is, how much the loan amount's going to be, and what your plan for the home's going to be as well. They're going to want to know all those things.
Andrea, I told her you got an answer to her question.
Oh, anything that is 10% or more of a down payment stays on for 11 years and then is removed off. If it's anything that is less than 10%, stays on for the life.
As far as mortgage insurance.
Mortgage
For
insurance, yeah.
FHA, for your FHA, okay.
Yeah. So
And that's
years,
across the board.
that's across the board now.
As of this year, 2025.
Thank y'all so much.
I appreciate
Thank
it.
you.